Hi, I'm MJR Invests. Vanguard have just produced their investment and economic outlook for the rest of 2024, covering places like the US, Europe, emerging markets, China and Canada, covering inflation rates and interest rates. So without further ado, let's go straight into it. The good news for people living or investing in the UK is that interest rate cuts are expected to come from August onwards. A continued moderation in wage growth and encouraging inflation news are behind this thought. Growth in average regular pay slowed to 6% between December and February, which is a sixth consecutive slowing in growth. Remember, if growth is slow, interest rates usually come down to support borrowing and stimulate economic growth. And when interest rates come down, investments typically go up as people look to invest. The reduction in inflation is predominantly due to a 12% decrease in energy prices, but tensions in the Middle East could change that. Vanguard predicts headline inflation to fall below 2% by the end of the year. The encouraging wage and inflation data support Vanguard's view that the Bank of England will begin interest rate cuts in August, with the interest rate falling by an entire percent from 5.25% to 4.25% by the end of 2024. This should stimulate economic growth and an increase in stock prices as people look to invest. GDP growth is predicted to be around 0.3% for the rest of 2024, but unemployment is expected to fall by 1% from 5 to 4%. Despite fears of economic slowdown in the US, production of goods and services remain healthy and underscore Vanguard's view that economic strength may prevent the Federal Reserve from cutting interest rates in 2024. Measured by the Consumer Price Index, services were 5.3% higher on a year-by-year basis, and headline inflation advanced 3.5%. Full year 2024 inflation is expected to be around 2.6%, and the labour market remains strong, with unemployment staying at around 3.9%. Vanguard expects economic growth of 2% in 2024, higher than their initial estimate of 0.5%. If you watch my previous Vanguard video, then you will know that emerging markets were very attractive. This has not changed. Amid continued economic strength in the US, Vanguard have upgraded their GDP growth for markets such as Mexico. Vanguard expect the world's emerging markets to deliver economic growth of around 4% by the end of 2024, led by growth of around 5% for emerging Asia. Vanguard forecasts growth of 2 to 2.5% for emerging Europe and Latin America, although US growth could pull Latin America upwards with them. China's economy made a solid start to 2024, but questions were raised about economic sustainability after the second quarter. Economic growth softened as pent-up post-COVID demand of goods could not be maintained. This soft patch is expected to flatten performance by the end of 2024, with China predicted to hit its growth target of 5%. There are concerns that China may not address underlying economic imbalances. These are likely to remain as the Chinese government look to invest in manufacturing upgrades rather than to support consumer spending, and this may add deflationary pressure. Vanguard expects China to cut its interest rates from 2.5% to 2.2% in 2024, and inflation to drop to less than 1%. Speaking on April 11th, the president of the European Central Bank said that the bank would be data dependent, not US dependent. Vanguard expects Europe to trim its interest rates by 0.25% at each of its 5 remaining 2024 policy meetings. Vanguard believe interest rates in Europe will end at around 2.5 to 3% by the end of 2024. Economic growth is expected to be just 0.5 to 1% due to the lingering effects of Europe's energy crisis. Unemployment should remain around 6.5%, and inflation is predicted to fall to 2% by September. Vanguard states that the last mile of inflation reduction worldwide will require progress on housing and services. Price increases for services excluding housing have accelerated since December, propelled by a tight labour market and strong wage growth. Meanwhile, a year-long slowdown in the increased price of housing has not been sharp enough to comfort the Fed in the US. Stubborn house prices reflect heightened housing demand, supported by a strong labour market and low supply. And this is also supported by the reluctance of many homeowners to give up low mortgage rates by moving to a new house and getting a higher mortgage rate. So what on earth does all this mean? Well, in the UK and Europe, they've both got low economic growth, so will look to cut interest rates to try and stimulate this. In the US, they don't really need to touch their interest rates because they've still got strong economic growth. China also have strong economic growth, but it's got a few imbalances in the economy which may affect it in the downstream. And in emerging markets, they are still looking like very, very promising investments. From an investment perspective, all of this looks good because interest rates and inflation are starting to drop worldwide. And as they start to drop, people then start to look to invest their money in the stock market, which will raise stock prices and increase your returns. If you enjoyed this video, then please remember to subscribe. I'm a relatively new channel and all of the support is very much appreciated.